afternoon and welcome to this, the final lecture in the series. In his first lecture, Professor Lowe described a model of population evolution which has some results that are quite at variance with standard economics. Yesterday, he discussed the psychology and neuroscience underpinnings of cognition and the limitations to our cognitive processes, the implications that has for the development of heuristics and rules of thumb, and the way in which those rules of thumb develop at the speed of thought. And in this final lecture, we'll come to the denouement, when we hear about the implications of some of these ideas for finance and the policies, problems, and puzzles in finance. So, Professor.
Before I launch into the third of these three lectures, I just want to say a final word of thanks, first to Oxford University Press for giving me a chance over these last 3 days to talk about my research in a somewhat more expansive format than a typical seminar. I really appreciate that. And I also want to thank my host at Saïd, former Dean Mayer, current Dean Peter Tufano, and all of the finance faculty for their gracious hospitality. I've had a great time over the last 3 days. And finally, to thank all of you for coming on a gorgeous Friday evening. I'm impressed that you're here, frankly, given how nice the weather it is outside. What I want to do today in my last of the Clarendon lectures in finance is to bring together the various ideas that you've been so patiently willing to listen to over the last 2 days into something rather practical, which is the hedge fund industry, which I refer to as the Galapagos Islands of finance for reasons that you'll see in a few minutes. It turns out that the only way to understand what's going on in the hedge fund industry is really through the lens of something like adaptive markets. The standard efficient markets hypothesis fails most miserably when you look at hedge fund managers, what they do, how they do it, and the kind of track records that they produce. There's no way to explain the kind of performance that they've been able to generate except through something like an adaptive narrative. So let me first start by defining what a hedge fund is. Many years ago, when I was first starting to learn about this, I spoke to a seasoned veteran in the industry to ask him what a hedge fund was. And he said, well, it's actually pretty simple. A hedge fund is a private partnership that has a beginning and an end. At the beginning, you have investors who come in as limited partners, and you have the portfolio managers who manage the money as general partners. And they each bring something into the partnership at the outset. The limited partners bring in the money, and the general partners bring the experience. And at the end of the partnership, the general partners leave with all the money, and the limited partners leave with all the experience. So, I didn't quite understand that at the time, but after a few years in the hedge fund industry, I finally got it. In fact, hedge funds are not so much an asset class as they are a legal entity, but a legal entity that actually has dramatic implications for how investment strategies have been deployed. They are unregulated investment vehicles that really cater to so-called sophisticated investors. Because you're not allowed to advertise to retail investors, and because the clientele is supposed to be high net worth individuals and so-called sophisticated clients, hedge funds can actually do things that mutual funds and other much more highly regulated financial vehicles cannot. Things like selling short, investing in illiquid assets, investing in a variety of different countries and strategies. So the hedge fund industry is really quite unusual in that respect. They have high fees, but at the same time, they also offer high performance. And in some cases, that even goes hand in hand, high fees and high performance, but not always. Hedge funds go back to Alfred Winslow Jones, 1949. That was the very first hedge fund. And the reason it was called a hedge fund is not so much because it purposely hedged, but rather because it was long and short. So therefore, market movements didn't have the same kind of impact on the value of a hedge fund than for a long-only fund. A hedge fund could be long 400% in an asset and short 400% in a different asset. So if markets go up or down, as long as those assets were correlated, you were likely to get relatively muted movements, but you could actually earn money when things went up as well as when they went down, and in some cases simultaneously. So really the idea behind hedge funds is so that you could actually engage in a more active, more dynamic strategies, which you can see why this is such an important part of the industry. Now, it's true that hedge funds have a relatively small asset base. The estimates currently are that hedge funds manage about $2 trillion, which is actually a small amount of capital when it comes to the financial sector. So why should we care about $2 trillion? In fact, after the LTCM debacle, one of my colleagues said, what's the big deal? Rich people lose money. Who cares about that? Well, the reason that we ought to care about hedge funds is because they have repercussions far beyond the investors that they cater to. For one thing, hedge funds play a really key role in the financial industry. They are the tip of the spear in taking advantage of any new investment opportunities that are created. And at the same time, they're also the canary in the coal mine. They're the first to die when any kind of dislocation hits. And we'll see some examples of that in a few minutes. In addition, hedge funds, because they're unregulated, they engage in tremendous innovation, much more quickly than in other parts of the financial industry. So if you want to see what the future of the financial industry looks like, take a look at what hedge funds are doing today. And in about 3 or 5 years, that's where mutual funds are going to go. Also, because of leverage, this $2 trillion has way more impact than you might expect. And because of the frequency and the size with which hedge funds trade, they have much more impact on any given day than other types of investment vehicles. And finally, if you think about investors in hedge funds, it's actually not just rich people that invest in them. Nowadays, there are many institutional investors that invest in hedge funds. In fact, I suspect that Oxford University's endowment is pretty significantly invested in hedge funds, and that means that a number of your contributions, as well as your 401k and your retirement assets, are also partly invested in hedge funds. So frankly, everybody should care about what's going on in the hedge fund industry, because what can happen in that industry can have broader repercussions throughout the financial system. Now, the reason that from the adaptive markets hypothesis we care about hedge funds is because, as in the Galapagos Islands, you can actually observe evolution going on before your very eyes. There are relatively low barriers to entry and exit, higher now than there were, say, 10 years ago, but nevertheless, still, it's easier to set up a hedge fund than it is to set up a mutual fund. So you have a lot of rapid innovation, as well as rapid declines, and there are new species that are emerging, as well as old species that are dying off really all the time. You can see strategies waxing and waning. For example, right now, credit strategies are waxing, and dedicated short bias strategies are definitely waning. We'll see that in just 1 minute. And finally, there's some really important empirical evidence for adaptive markets that come out of the hedge fund industry. I'm going to show you one very extended example of that. So let me show you quickly what I mean when I say that the hedge fund industry is dynamic. This is some data for the number of funds that have been born year by year in hedge fund land, according to the Lipper-TAS database. There are many different databases for hedge funds. They have some overlap, but not total overlap. And so we don't know all there is to know about the hedge fund industry, because hedge funds are not required to report. But from the voluntary data that we have, you can see that year by year, across all funds from 1994 to 2010, we have a lot of hedge funds that are springing up. For example, in 1994, there were about 500 of them, but shortly after LTCM, you had something like 1,250, and at the peak of the hedge fund craze, 2006, you had about 2,300 new hedge funds being launched. And you can see the different categories of hedge funds there. Among the largest category, fund of funds, has been very, very active in helping investors allocate money across different hedge funds. That's the births. What about the deaths? If you look at the deaths on the next slide, you can see that there are virtually as many funds that go out of business as come into the industry. Extraordinarily dynamic. And this is really why the hedge fund industry has the kind of patterns of change that you see. To give you one example of why it is that this is going on, in 2012, Credit Suisse provided a report of the amount of assets going into or out of particular categories of the hedge fund universe. So let's just take a look at one of them. Convertible bond arbitrage. That's a particular strategy that engages in long and short strategies among convertible bonds and equities of publicly traded companies. In 2012, 20% of the assets that were in that strategy actually came out by year end. Dedicated short bias. These are managers that are basically trying to short securities. That's their goal. They're not trying to hold anything long. They're trying to sell the losers. This particular strategy lost over 40% of its assets by the end of the year. I mean, that's a tremendous amount of turnover in terms of assets, and you can understand why. Last year, any short sellers got killed because the S&P went up dramatically. And where is the money going? Well, it gets allocated to other kinds of non-hedge fund categories, but within the hedge fund categories that are there, fixed income arbitrage, global macro, managed futures were the winners at the end of 2012. Very dynamic industry. Now, I want to talk about a very specific episode to give you an example of this dynamism and then come back to what this means for adaptive markets. During the second week of August 2007, I suspect many of you were on holiday or not focusing on markets in particular, and I was as well. But I got a phone call from one of my former students who had gone into a quantitative hedge fund as a career. He called me up and said, how are you doing? And I said, fine. You know, how are things going? He said, well, you know, we had a pretty bad day today. You know, we lost some money. And I said, yeah, and? But you're a hedge fund, right? You're supposed to lose money. And he said, no, you don't understand. We lost a lot of money. And I said, well, I know, but don't hedge funds do that from time to time? And he says, no, you really don't understand. We lost a real lot of money. And I said, well, you know, how much? And he said, I can't tell you that. And so I said, well, why are you calling me? And he said, well, because I want to know, have you heard of anything? Have you heard of what's going on? Now, remember, this is somebody who's a Wall Street veteran calling his finance professor, asking if he knew what was going on. That's not a good sign. And so I said, no, I haven't heard anything. You know, why don't you tell me what you guys have been up to? And he said, well, I can't do that. And he hung up. That was it. Short conversation. So I thought nothing of it until the next day, Tuesday, August 7th. I remember the dates, so you can tell this is pretty significant. The next day, I got a call from another student, another former student, who's also at a different quantitative hedge fund. He asked me exactly the same thing. Have you heard what's going on? And I said, no. He said, well, you know, we lost a lot of money. And once again, went through how much money. I can't tell you. You know, well, what are you doing? I can't tell you. So that was it. By Thursday, and after the fourth or fifth call, I don't remember which, I realized that something unusual was going on. And what happened during that second week of August was really unprecedented from the perspective of financial markets and the hedge funds. What happened in the second week of August of 2007 was that all hedge funds who were doing a very specific strategy, quantitative, equity market neutral, AKA stat arb, they all lost money in that second week of August. Now, I suspect that those of you who are not in that area of stat arb strategies, you have no idea what I'm talking about. You don't remember anything particular about August 2007. And for those of you who were in the stat arb or are in the stat arb area, you remember exactly what I'm talking about during that second week. Now, of course, since I was out of that part of the hedge fund space by then, I didn't know what was going on. And so I started talking to a student of mine, a graduate student, asking him, well, you know, how do we figure this out? Because obviously there's something going on. And a few weeks later, the Wall Street Journal wrote about the so-called quant-equity meltdown of August 2007. It was on the front page of the Wall Street Journal in the beginning of September, how market turmoil waylaid the quants. The problem was the quants weren't talking. In fact, they aren't allowed to talk because as part of a hedge fund, you protect your intellectual property by trade secrecy. There's no patents on investment strategies, so you aren't allowed to tell outsiders what you're doing. You're trying to protect your shareholders' intellectual property. So my graduate student, Amir Khandani, and I, we decided that what we would do is to try to simulate a simple quant equity market neutral strategy just to see what would have happened had we run that strategy during the second week of August, because we couldn't figure out any other way to sort out this issue about what happened with the so-called quant meltdown. And the reason this meltdown was so unusual is because it only affected quantitative equity market neutral managers during that first 4 days of the second week of August 2007. This is akin to, the Jewish experience of Passover. I don't know how many of you celebrate Passover, but in Boston, it's a very important holiday, as well as in New York, where I grew up. And I figured out a long time ago that it has a rather macabre origin, where basically you're celebrating the fact that when the Israelites were imprisoned by the Egyptians, they prayed to their God, and the God said, take lamb's blood, paste it on the outside of your door one Friday evening, and by Saturday morning, you will be free. And of course, what happened was the angel of death came and killed all the firstborn of all the homes that didn't have the blood on their doorstep. Well, that's exactly what it felt like to be a quant equity market neutral manager during that second week. You felt like the firstborn Egyptian son, because they all got killed and everybody else was doing just fine. Nothing was going on other than in this one space. They all lost money, and nobody knew why. So we simulated a strategy. A strategy is a daily mean reversion strategy. We take a look at yesterday's winners and losers relative to the market average. And what we do in the simulation is we today buy yesterday's losers, and today we sell yesterday's winners, so that the losers and winners have the same market value, so the net investment is zero. This is an equity market neutral strategy of a very simple sort. And the degree to which you buy and lose, you buy and sell, is the degree to which winners and losers win and lose in the previous day. Okay? So this is a very simple strategy. Here it is, nothing proprietary about it. We'd written papers about this years ago. And so we simply simulated it to see what would happen. So let me show you a little bit about the performance of the strategy before we get into what actually happened during that second week. So these are annual statistics applied to daily data from 1995 to 2007. On average, we're getting a 1.38% return in 1995. That's the average daily return. Now that doesn't seem so impressive until you realize that that's a daily return. You have to multiply that by 250. So this is a really good strategy. Now, of course, it's totally unrealistic, because we're applying this to 1,500 stocks, trading every single day, no transactions costs, no commissions, no frictions, no market impact. So it's really a very naive calculation here. And so you're not likely to get this in practice, but just as a point of context, that's what the return is. But it goes down all the way. In 2007, the return goes down to 13 basis points a day, which 13 basis points a day is still pretty impressive. That's still over 25% annualized rate of return in 2007. Again, no transactions cost. I'm not deducting any kind of market impact. So this is not meant to be a realistic simulation of what you would actually get. It's meant to be a microscope for us to look into what's going on in the marketplace across time. Now, what about the risks? I mean, maybe this is a hugely risky strategy. High expected rate of return, high risk, no big deal. Well, if you look at the standard deviation is 0.4% per day back in 1995. So 1.38 divided by 0.4, that's a Sharpe ratio of somewhere in the neighborhood of 3.5, right? That's a daily Sharpe ratio. To get an annualized Sharpe ratio, you multiply by the square root of 250, roughly 16. So this is a Sharpe ratio of about 50, which is actually higher than Renaissance's Sharpe ratio. Clearly unrealistic. But nonetheless, the Sharpe ratio does come down, so you can see that 13 basis points versus 72 basis points of volatility. By 2007, it's not as profitable a strategy. So let's take a look at the performance of the strategy. This is the expected value of the strategy, which is pretty much monotonically declining over this period. And what I've got superimposed behind it is the amount of assets that are dedicated to equity market neutral and long-short equity strategies in the Libertas database over that same period of time. More and more money is coming into the space. Why would more money be coming into the space despite the fact that the returns have been systematically declining? Well, first of all, these are the returns of a very naive strategy. So it may be that hedge fund managers have come up with other more sophisticated strategies that continue to do well. But in fact, when you simulate other kinds of strategies with factors, using longer holding periods and so on, they all systematically decline over this period. So what do you think is going on? Why are more and more investors piling into the strategy? Well, one conjecture, which all of this, by the way, is conjecture. We can't prove any of this. One conjecture is that as the returns deteriorate, hedge fund managers are deploying more leverage. and broker-dealers are allowing the leverage for their hedge fund managers. And so we asked a very simple question, just to compare apples to apples. How much leverage would you need to apply in 2007 in order to get the same expected return for your strategy back in 1998? That's the LTCM year, and I'll show you why I picked that year in a little bit. So what we want to know is how much leverage you would need to apply here in order to get the same returns as the strategy back here. And the answer is about 8-to-1 leverage. 8-to-1 meaning for $100 million, you want to be investing $400 million long and $400 million short. And in 2007, we asked a number of prime brokers that we happen to know what kind of leverage they offer to stat arb managers, and they said anywhere from 6-to-1 to the high of 13-to-1 in certain cases for offshore entities that register as broker-dealers and so on. And so 8-to-1, they said, was actually a pretty reasonable number for the amount of leverage in that year. So with that amount of leverage, it turns out that when you simulate the strategy, it's got a daily expected rate of return of about 60 basis points and a daily standard deviation of about 200 basis points, about 2%, okay? That's just a way for you to gauge whether or not the numbers I'm about to show you are big or small. So this strategy, on average, given the leverage that we propose, it's going to have roughly a 0.6% return per day and a standard deviation of about 2% per day, okay? So now let's see what happened during the second week of August 2007. First, the beginning of the week, August 6th, was a day like any other day. This strategy produced a 2% positive rate of return. 2% rate of return, which is just one standard deviation, not a big deal either way, right? But August 7th, this strategy lost 4.6% in a day. Now that's a 2 standard deviation loss, right? A little bit more than that. Two standard deviations would be 4%. It lost 4.6%. That's a bad day. But it's not a really bad day. It's just, it happens. A 2 sigma event under normality happens roughly once every 20 days, right? 1 out of 5. So this is not in and of itself a big deal. But on Wednesday, August 8th, this same strategy lost 11.3%. That's a really bad day. That's a 5 sigma event following a 2 sigma event. And on Thursday, August 9th, this strategy lost another 11.4%. Now remember, you're running a strategy that has a daily sigma of 2%, and within 3 days, you've lost a quarter of your assets. You've lost 25% in 3 days. That's when you start calling your finance professor, this is really a bad day, right? In fact, David Vanier, the chief financial officer of Goldman Sachs, was quoted as saying that their global alpha fund experienced a 25 sigma event. That's what he said. He actually said it. It's in the newspaper. Now, anybody who ever says that and has any kind of an advanced degree should automatically be shot, or the degree should be revoked. Because the last time a 25 sigma event occurred was, I think, sometime in the Cretaceous period, right? I mean, it can't ever happen. What obviously has happened is he's got the sigma wrong, right? It's not the same old sigma that you're using. So a lot of stat arb managers, not knowing what's going on, what did they do? They decided to cut risk, because that's the natural reaction. If you lost money and you don't know why, and it's outside the envelope of reasonableness, you better cut your losses. So they did. They did that on Wednesday, and on Thursday, they basically cut their risk by a significant amount. They lost 25%, and they said, no more, I can't take it, I'm getting out. So what happens on Friday? Well, you know what's going to happen on Friday, of course. Friday, the strategy produces a positive 24% return. It snaps back. So you've just locked in your losses, right? Because you cut your risk, and now the portfolio comes back by about the same as it's come down. Although, if you go down by 25% and you go back up by 25%, you realize you don't go back to even, right? You understand this. I always ask, because when I was in high school, I took a summer course in economics at a local community college in New York. And I remember very clearly one of the examples that the instructor, who was a graduate student, gave. She said, imagine having a GDP of 100 billion and it goes down by 10%. Now you're at 90. And later on in the lecture, she said, imagine you're going up by 10% from 90 to 99. And somebody in the audience said, excuse me, professor, but why is it that when you go down by 10% and you go up by 10%, you don't get back to 100? And she thought about it for a while. She said, well, economics is an inexact science. So, I guess so. I don't know. Anyway, you don't go back to even. And certainly if you cut your risk by half, you've locked in half of those losses. You're done. And a lot of funds actually lost money, so much so that by the end of the month, they were out of business. Now, the thing that really strikes everybody is the fact that if you look at all of the other indexes in financial markets during the beginning of that week, you couldn't tell if anything else was going on. For example, here are S&P 500, small cap, MSCI, Lehman Ag, Goldman Sachs Commodity Index, Trade Weighted Index, the VIX. Look at this. On Monday, the VIX was down. Tuesday, the VIX was down. Wednesday, the VIX was down. Only by Thursday did the VIX shoot up a great deal. So for the first 3 days of that second week of August 2007, the risk looked like it was coming down. The S&P was doing just fine, thank you. There was nothing going on in emerging markets. Fixed income markets were just fine. It was just the quantitative equity neutral managers that were getting hit at the same time. And it was only until Thursday that now the S&P went down by 3%, which is pretty significant for the S&P. And I don't know how many of you remember this, but Thursday night, the central banks around the world met, and they decided to do something that they hadn't done. Well, actually, I don't think they ever did in a coordinated fashion. They all agreed to inject liquidity into the marketplace Thursday night. So what was going on? Well, the puzzle gets a little bit clearer when you look at the LIBOR-OIS spread, which is, by the way, nothing that a stat arb manager would have ever looked at prior to August 2007, because LIBOR is a measure of interest rates. It's nothing to do with equities. And the LIBOR-OIS spread is a measure of sort of interbank lending and credit risk. Well, let me show you what happened. This is the LIBOR-OIS spread, and this is August 10th, 2007. This is what the central banks were responding to, not the stat arb managers. I don't think that the central banks understood what stat arb was or is. But what happened during that Thursday was that the LIBOR-OIS spread blew out. For all intents and purposes, the money markets of the world through the interbank loan market had a heart attack, a myocardial infarction, and lending stopped for a brief period. And the central banks freaked out and they said, we need to inject liquidity right away. And they did. But at the same time, the stat arb managers were also looking for liquidity, and they happened to have gotten it as well, and that's why you saw a rebound. At least that's why we think you saw a rebound. Now, this looks bad, but let me show you what the aftermath of the LIBOR-OI spread looked like the year or two afterwards. So this is August 2007, and this, of course, is Lehman Brothers. So this was just a little heart attack relative to the massive coronary that the financial system got over a year later. Now, what's particularly puzzling is when you compare what happened to stat arb managers with what happened in 1998. In 1998, credit markets also blew out. We also had a huge spike in credit spreads after Russia defaulted on its government debt. Remember that? August also happened in August. August is a bad month for financial crises. So let's see what happened to this strategy in August of 1998. Well, here's the day, on August 17th, this is when Russia defaulted on its GKO bonds. The stat arb strategy was up 1%. On August 21st, LTCM reported a $600 million loss, which back in those days, $600 million actually meant something. And on that day, this strategy produced a positive 1% return. On September the 3rd, LTCM issued a letter to their investors saying that if they can't find a buyer for their portfolio, they're going to have to liquidate $4 billion of bonds over the course of the coming few weeks and months. And on that day, this strategy produced a 1.4% return. And finally, when the bailout was announced on September 24th with the consortium that was going to be bailing out LTCM, on that day, this strategy produced a 1.21% return. Totally ordinary. There was no effect of credit markets on this strategy in 1998. Now, we don't know why, but we have a conjecture. And the reason we don't know why is because we don't have the data. We don't think anybody actually has the data that's necessary because hedge funds are not required to disclose the data. But what we conjecture happened has to do with one final simulation that we did. And the simulation has to do with market-making profits during August 2007. Market making is the process of providing liquidity to various market participants. And you can think of stat arb in a way as providing liquidity because you're buying losers and selling winners. When you say you're buying losers, what you're saying is you're buying stocks that people want to sell. You're effectively providing them with liquidity by taking these stocks off of their hands. So if you simulate an explicit market making strategy within the day, what you would do is to say what happens over the last hour, take the losers over the last hour, and then buy those in this hour. And take the winners over the last hour and sell them this hour. Because there's actually quite a bit of positive persistence in buy and sell orders. So when people want to buy, they continue buying. And so if you use a mean reversion strategy at a relatively higher frequency, you can actually simulate what a market maker, like a New York Stock Exchange specialist, would make. So let me show you, using tick data, what the results are of the cumulative profits of a market maker that makes markets intraday from July 2007 all the way to the end of September 2007. So this is using the data and using mean reversion over different holding periods. Let me show you the 1 hour strategy first. These red bars indicate the second week of August 2007. So the cumulative profits of a 1 hour mean reversion strategy is this green line. You can see that it's slightly upward sloping, which means that you're on average making money, but not a whole lot of it. And there's a very slight little dip during that second week of August 2007. Here's half an hour. Here's 15 minutes. Here's 10 minutes. And now, I wish I had a drum roll. Here is 5 minutes. Look at that. Back in those days, a 5-minute strategy was considered high frequency. Today, this is a long-term investment plan. But look at what's going on. You're making money very consistently. The smoothness of the line tells you that this has got an incredible Sharpe ratio. You're making money very consistently until the second week of August 2007. That Monday, you're flat. Tuesday, you're flat. And Wednesday, you take a little dip right there. That's Wednesday. So if you're running the strategy on a 5-minute basis and you lose money on Wednesday after having made no money on Monday and Tuesday, after having been so consistent in making money every day for the last 3 months, what are you going to do? You'll stop trading, won't you? You'll pull out your capital. You'll say, you know what, I'm going to take a break until things get better. And so we conjecture that that's what happened. That during that second week of August 2007, traditional market makers could not take a break, but market makers that came into the space, namely hedge funds that were engaging in relatively higher frequency statistical arbitrage, detected that their strategies were not working and decided to turn those machines off. And when they all turned them off at the same time, that caused a loss in those kind of portfolios because turning them off meant not only stopping trading, but unwinding your position, so going the opposite of what you were doing before. And when you go the opposite of what you're doing, you hurt your portfolio's value, but you also hurt everybody else who has portfolios similar to you. So the conjecture that we put together is what we call the unwind hypothesis in 2 papers, 2007 and 2011, that the large and rapid losses was due to the unwinding that occurred during the first few days of that second week of August 2007, and that the reversal was after the unwinding was done, the buying pressure was off, the strategy basically started working again, and you remember that by the end of Thursday and early Friday, Goldman had announced that they had actually found a very large credit line for their global alpha portfolio, and they were to go in and buy massively to try to basically stem the tide and recover some of their losses. So they basically doubled down on Friday, and that actually caused the reversal among other people who are bargain hunting. So how and why did this happen? That's a more complicated question. Again, this is still conjecture. Remember, we don't have the data, so we don't have proof. And there are people, perhaps even in this room, that actually know what happened and are not allowed to say what happened. But this is the best we can do, given that we don't have all of the data. We conjecture that this is what happened. Now, obviously, this was an example of one of the repercussions of the subprime mortgage meltdown. Our further conjecture, which we try to substantiate in other ways in the paper, is that there was some large investment bank or commercial bank out there engaged in this particular strategy. They received a margin call on their credit portfolio because subprime loans were actually getting hit pretty hard. Credit spreads were widening. They were losing money. They needed to post margin, so they started liquidating various different kinds of assets and strategies. And in August 2007, the strategy du jour to be liquidated was equity market neutral. So obviously, this was a repercussion of the financial crisis. And I'm not going to talk about the financial crisis in any depth here. I'm sure you've heard more than you care to about it by now. But let me just summarize the financial crisis in one slide for you and then talk a bit about how we got to that point. So the way that I summarize it is by using Bob Shiller's US Real Home Price Index on a national level from 1890 to 2012. And let me show you what that looks like. First of all, let's look at the population of the United States. Certainly the population has grown from something like 60 million in 1880 to about 330 million today. So you would expect that homes are going to be a more important part of the economy. And here's the real index for home prices across the country. Now, this is a real index, so that remember, this adjusts for inflation, so you can compare across time. Does anybody notice anything unusual about this index? Now, this is only to the peak of the housing market in 2006. And clearly, the last 10 years was extraordinary in this time series. Something happened then. And of course, the happy ending has to come to a close because we know that what goes up must come down. And we're now back down to about the steady state level of home prices over the course of a 50-year period. How did this happen? How were we able to nearly double the value of US residential real estate in the space of 10 years? Well, there are many factors that contributed to that, but let me show you a little bit about the size of mortgage debt during that period of time. So mortgage-related debt, which includes not just mortgages, but all of the securitizations, CDOs, CDO squareds, and so on. Mortgage-related debt in 1996 in the United States was $480 billion. That's how many mortgages that were written in that 1 year. 7 years later, just 7 years later, that number went to over $3 trillion. In 2003, we issued over $3 trillion of mortgage-related debt. That's why around this time, when Paul Krugman, the New York Times columnist and Nobel Prize-winning economist, when he was asked, how would you summarize the US economy? He said, very simple. We buy and sell each other homes using money borrowed from the Chinese. That's it. What could possibly go wrong with this? What could go wrong with it? Well, I think you know what went wrong with it. But the larger question is, how could this have happened? How could, as sophisticated a country and financial center as the United States, how could it have happened? And one way to ask this is to say, who benefited from the trend of increasing home prices and financial innovation? And if you do an honest accounting of all of the parties, all of the stakeholders that benefit from this, well, pretty much you get everybody, right? Commercial banks, credit rating agencies, economists, government-sponsored enterprises, homeowners, insurance companies, investment banks, investors, mortgage lenders, politicians, and regulators. A rising tide lifts all boats. I think it was Warren Buffett who added that it's only when the tide goes out that you can see who's swimming naked. And apparently, quite a few people were swimming naked. But the point is that everybody benefited from this, not to the same degree, and so I'm not arguing that we're all to blame. Obviously, the blame game is happening right now, and we have to apportion blame and figure out who done it and provide the proper consequences. But what I'm focusing on is a broader theme, which is that when you have a situation where everybody is benefiting, that's where you can raise tremendous assets and where the force of nature takes hold of these markets. In particular, it has to do with something that we talked about both yesterday and the day before, which is the fact that in an adaptive market, you need to have countervailing forces in order for there to be any kind of adaptation. And in particular, in order for you to reduce your leverage at a given point, you've got to have negative feedback of some sort, either from yourself, saying, gee, we're really highly leveraged, and maybe we don't want to lose that money we've made, or by somebody else saying, you know what, you're taking too much leverage, I'm not going to allow you to take any more leverage. In fact, I'm going to force you to cut back. Those decisions require some form of negative feedback in somebody's brain. If everybody's brain is getting only positive feedback, you're not going to engage in that kind of behavior. So pain and negative feedback generally produce responses. I'm not arguing that it's good or bad, I'm simply stating a matter of fact. They produce responses. For example, I noticed that in this room here, we have a number of fire protection systems. We have a sprinkler system, we have smoke detectors, there are well-lit exit signs that tell us how to get out. All of these protections actually require money to build into a building. They're quite expensive to build in a sprinkler system in a building. But here in England, as well as in the United States, there are laws that require all commercial builders to have this. Why? Why not let markets be free to choose? You can choose a building that doesn't have this protection and choose others that do for those who are more paranoid about fires. Well, the reason that we don't is because we have laws having experience that nobody wants to pay for it, and yet after the fact, everybody wants it when the fire starts. We decided to incorporate that into law. And in the United States, that happened exactly in 1911, 1913, because on March 25th, 1911, there was a very big fire in a clothing manufacturer's factory, and 146 people died. After the Triangle Shirtwaist Factory fire, 60 different laws were enacted, not only in the state of New York, but across the country, to impose these restrictions. So negative feedback is valuable. What if we didn't have negative feedback? Imagine a world where you felt no pain. Now, it turns out that medically, it is possible to do so. It is possible to remove all pain from a person's experience. And the method is methamphetamine. Crystal meth is one of the most effective ways of eliminating pain. Imagine if you were on crystal meth. People tell me, I don't know, I've never tried it. People tell me it is the most amazing experience that they've ever had. It's like sex, but better, because it lasts and lasts and lasts. And when you think about it and you hear about it, it sounds incredibly tempting, which actually scares me because I can see why it is so addictive. You try it once, you will never want the feeling to stop, because imagine a world where you feel no pain. So here's an example of a methamphetamine dealer. She was caught and arrested. This is her arrest photo from when she was just dealing. She wasn't an addict yet. 1 year later, she was rearrested because she had become an addict. This is the photo of her literally 1 year later. Same person, 1 year later. You notice, for one thing, she actually has no teeth. It turns out that crystal meth addicts, because they don't feel pain, any kind of toothache completely disappears, and they will continue chewing. Even if they break their teeth, it will be no problem. So pain is unpleasant, but useful. Pain can be good for you if it's protecting you for something. Now, why? Well, in the adaptive markets context, pain is particularly important because what it does is to help you sort through all of the different narratives. Remember, we talked yesterday about the importance of coming up with narratives because humans, as part of our intelligence, want to predict what's going to happen. So we rely on narrative to make those predictions. Well, key about narrative is that the evolutionary process has to select among the best narratives. By best, I mean narratives that will be conducive to your reproductive success or conducive to some form of success, however you measure it. As long as pain is accurate in providing us with feedback to the less successful narratives, we will improve. Natural selection will work. If we block pain, effectively we move the link by which selection is occurring. And in some cases, that's actually very beneficial. When you're undergoing surgery, it's actually very good for you to have no pain. It's not good for you to feel an appendectomy while you're going through it. But for most other situations where there isn't this beneficial aspect of anesthetic, having that anesthetic could be tremendously damaging. And during the course of the build-up to the financial crisis, one could argue that the entire financial system, as well as the real economy, was on a very large dose of anesthetic. Nobody felt any pain. In fact, what is a government guarantee? A government guarantee is an anesthetic. Don't worry about defaulting. I will protect you from that pain. Now, I'm not arguing against government guarantees, don't get me wrong. This is not a political statement. Again, it's a statement of fact. That's what guarantees do. In some cases, very good. Surgery, you want to be immune from the pain. But in other cases, it could be very, very bad. The one thing that protects us from coming up with these inappropriate, incorrect narratives is the ability to conduct scientific inquiry, the scientific method. The only reliable way for us to be able to sort through good narrative and bad narrative is through empirical investigation and objective analysis. Now, on Monday, remember I mentioned that Paul Samuelson brought us down the path of physics envy. But in fact, I've been criticized by physicists saying that, economists, they actually don't have physics envy. And the reason is very simple. They don't have physics envy because physicists, we actually do experiments. And if the experiments don't agree with the theory, we don't throw away the experiment. We throw away the theory. Whereas economists stick to their theory. And so, in fact, it was Doan Farmer who pointed this out to me originally. Thank you, Doan, for that. Economists actually suffer from theory envy. And the only way to get out of that theory envy, the only way to get out of focusing on a faulty theory is the scientific method, is to look at data. So let me give you an example of this. There are many narratives that have occurred regarding the financial crisis. These are some narratives that you may have heard of. The crisis started with a run on repo. Bankers didn't have enough skin in the game. Wall Street bonuses were too high. Predatory lending created the subprime crisis. Nobody saw this coming. The devotion to market efficiency is really what caused the crisis. And finally, it was changes in regulation, particularly at the SEC in 2004, that actually allowed so much leverage to go on. But are these narratives true? I would argue that every single one of these narratives has some very faulty logic underlying it. I'm not arguing that they're all false, but I'm arguing that we actually don't know what the answer is because we haven't done a thorough empirical investigation of any one of these. There are a couple of them where we do know by a matter of fact that they're false. For example, this last one, changes in regulation allowed huge increases in leverage. It turns out that that was a myth perpetrated by a former SEC official who didn't know any better. He made a mistake, but it got picked up by the press, then it got picked up by academics, then it got picked up by politicians, and has actually affected policy. Now, once again, I'm not trying to argue for any policy view here. I'm trying to argue for accuracy. And it turns out that all of these narratives are now so laden with emotion and political force. In fact, depending on your view of each of these things, you will automatically be labeled in the United States either a Democrat or a Republican, very simply, irrespective of the underlying scientific merit of any of these narratives. So what can we do about it? Well, there are many things that we can do about it, but the only thing that I know for a fact we ought to be doing about it is we ought to be applying the scientific method, and we ought to be developing feedback loops that allow us to experience pain when we ought to. And so one way to do that is to use the National Transportation Safety Board model. This is a part of the US government that investigates accidents, including plane crashes. Interestingly, the NTSB has absolutely no regulatory authority. And that's actually a real plus, because all they do is to investigate accidents and report on what happened, how it happened, why it happened, and what can be done to prevent it from happening again. And they are free to criticize everybody and anybody that was complicit in these accidents, including the regulator themselves. And they've done so. They've actually criticized the FAA, the Federal Aviation Administration, for being a little too cozy with industry in certain cases and being not responsive enough in other cases. So an example of this is US Air Flight 405, which is an airplane that crashed because it was de-iced in freezing rain a little bit too soon. And it sat on the runway for about a half an hour too long, and the de-icing fluid lost effectiveness, and the ice built up on its wings. It crashed, and it killed 27 people. So now, when you go on an airplane in wintertime and you get de-iced just before you take off. Well, you have the 27 people who died on Flight 407 to thank for that, because it was after that event that the NTSB put together a report, made that conclusion, and that changed the way we de-iced airplanes. That's an important difference in how other industries behave versus how we in finance behave. We don't do this kind of accident investigation. So these are all the different things that can be done. I'm not arguing for any one of them other than the one that's listed in blue, which is doing that investigation. That I know is going to be positive in terms of its impact on financial markets. The things that I've listed in red are things that we actually could have done even before the Dodd-Frank Act of 2010. We didn't need any new laws to do the things in red, and yet we decided not to do them because nobody was feeling any pain and any need. Okay, so let me start wrapping up and applying this to financial markets. The idea of narrative is critical. And let me give you an example of the narrative that we tell our MBA students all the time. The narrative has to do with the creation myth that financial economists have perpetrated on our students. And the creation myth goes like this. In the beginning, and by the beginning, I mean 1964, in the beginning, Bill Sharp said, let there be beta, and there was beta, and it was good. Beta allowed us to differentiate between commoditized expected return generation versus unique investment returns, the so-called alpha, but most importantly of all, it actually gave us an ability to discharge our fiduciary responsibilities in managing client money. Now, the CAPM requires certain assumptions. And these are the assumptions that it requires. You have to assume linearity. You have to assume that the returns are stable over time. You have to assume that investors engage in rational behavior. And most of all, you have to assume that markets are efficient. What if these assumptions don't hold? In fact, I would argue that none of them hold perfectly. Well, let me show you a new narrative for how we interpret this. These are the returns of a well-known investment you may have seen, the S&P 500. You probably don't recognize this because I've plotted it on a logarithmic scale. On a logarithmic scale, the same vertical distances correspond to the same returns. And so what this shows is that during a 6 or 7 decade period, we had a remarkable run in US equity markets where it looked like the returns and risks were relatively stable. During that period, the assumptions of the CAPM held to a reasonable approximation. So it's not surprising that the CAPM came about because actually 60-40 investing worked pretty well from the 1930s all the way to the 1990s and early 2000s. The question is, do you believe that they still hold today? Because we've had 10 years of some very strange equity returns. Do you believe it's a blip? And we're going to go back to that great kind of a trend. Now, if you take a look at Japan, you see a more sobering story. Japan had that same kind of behavior of linear trend, and over the last 25 years, it's been going sideways to negative. So the implications are many. I'll give you one implication, and then I'm going to conclude. One implication is that in finance, we usually think there's a risk-reward trade-off, right? Higher risk, higher expected return. And this is true. If you take a look at the Ibbotson data from 1929 to 2009, higher expected rates of return assets have higher volatilities, one measure of risk. So the risk-reward trade-off seems perfectly reasonable. However, if you take that same trade-off and you look at it over a shorter time period, say a rolling window of 5 years, then a rolling window of 5-year risk and reward trade-off looks very different. So in blue, we have the expected returns, average returns over 5-year rolling windows, and in red, we have volatility during those same windows. Low return, high volatility. High return, low volatility. Low return, high volatility. High returns, low volatility. This seems to contradict this risk-reward trade-off. But the point is that the risk-reward trade-off is a long-term relationship. It doesn't hold at every point in time, and it certainly need not hold over shorter windows. There are many other implications of adaptive markets that I don't have time to go over today, but you're welcome to take a look at some of the papers that we've written on this. But from the lens of adaptive behavior, everything changes, as I said in the very first lecture. And so let me conclude now by trying to explain a little bit about what we're hoping to accomplish in this research agenda. If you look at across all of the disciplines that I've listed here, many disciplines focus on human behavior, everything from anthropology and biology all the way down to psychology and sociology. Economics is only one of those disciplines. What's the common denominator in all of these disciplines? Well, the answer is pretty simple. The common denominator is Homo sapiens. We're studying the same objects. And so it better be the case that whatever we study should be consistent across the fields. We don't study the same aspects of Homo sapiens, but when those aspects overlap, they better agree or something is wrong. And this was said best by E.O. Wilson, the great evolutionary biologist. In 1998, he published a book titled Consilience. That's a word that was first coined by the British philosopher, polymath, scientist, William Whewell in 1840. Whewell wrote, "The consilience of inductions takes place when an induction obtained from one class of facts coincides with an induction obtained from another different class. This consilience is a test of the truth of the theory for which it occurs. The idea being that if we're studying a phenomenon from different disciplines, they better agree. If they don't, one of the two or both fields are mistaken. Now, I started this lecture series with Samuelson, and I pointed out that Samuelson set us down this path of physics envy. But surprisingly, in his thesis, Samuelson was actually quite wary of the hazards of physics envy. And let me read to you what Samuelson wrote in 1947 as a graduate student. Only the smallest fraction of economic writings, theoretical and applied, has been concerned with the derivation of operationally meaningful theorems. In part, at least, this has been the result of bad methodological preconceptions that economic laws, deduced from a priori assumptions, possessed rigor and validity independently of any empirical human behavior. But only a very few economists have gone so far as this. The majority would have been glad to enunciate meaningful theorems if any had occurred to them. This is a graduate student writing. He's got a lot of chutzpah. In fact, the literature abounds with false generalization. We do not have to dig deep to find examples. Literally hundreds of learned papers have been written on the subject of utility. Take a little bad psychology, add a dash of bad philosophy and ethics, and liberal quantities of bad logic, and any economist can prove that the demand curve for a commodity is negatively inclined. Samuelson said this himself, the father of the whole physics approach to economics. So I want to give you a new narrative. It takes a theory to beat a theory. And the new narrative is that the efficient markets hypothesis is not wrong. It's simply incomplete. It focuses on that left brain activity that we all engage in and love and respect. But that's not all there is to human behavior. It's like the parable of the 5 monks who are blind from birth. They encounter an elephant for their very first time, and the monk that grabs the elephant's trunk says, an elephant, it's just like a snake. And the monk that grabs the elephant's leg says, the elephant, oh, it's just like a tree. They're not wrong, but they're not complete in their understanding of what an elephant is. Human behavior has been stable for about 60,000 years, but our environment has changed tremendously during that period of time. And this mismatch can create challenges, behavioral challenges. So it's really Charles Darwin more than Adam Smith that has much to say about markets today. It's really through evolution and the process of competition, innovation, selection, and adaptation that we can understand dynamics. And the bottom line is, how dynamic are you? How adaptive are you in this kind of a crazy world that we live in? This was brought home to me in a very personal way several years ago when my younger son had turned 5. At the time, my older son was 10. So he spent the day raining on his younger brother's birthday parade. He said to his younger brother, you know, Wesley, today you're 5, but I'm 10. I'm twice as old as you. I'm twice as tall as you. I'm twice as strong as you. Basically, I'm just twice as good as you. And they got his brother very, very upset. You know, he was 5 years old. And so it wasn't until dinner time when at the dinner table, my younger son's face lit up. I realized that he had a retort. And he said to his older brother, Derek, you're twice as old as me, right? Derek said, yes, I am. He said, that means you're going to die first. If you understand that, you understand adaptive markets. Thank you.